Hello everyone, Wednesday, February 2nd. This is John Hardy with the Saxo Bank FX update. We were pretty quick to hop on board yesterday with the big move up in risk appetite, but a couple of people pointing out, especially Gluskin Chef's Dave Rosenberg, who's very helpful, I think, in this market environment and whose view we share on many things. If you look at the first day of the trading month in equities, this being yesterday's, it's been very strong and actually explains a very good deal. This is January 1st, December 1st being the most famous, perhaps after QE2 was announced in November and we had some uncertainty, and then we really took off on a rocket ride. So you could say we've simply had a first day of the month. This is a seasonally or a day of the month that sees a lot of buying, and we were trying to erase the Egypt effect. Maybe we're too quick to hop on board, maybe not. Certainly we've seen some moves. We haven't retraced those moves yet. But I think another day of trading makes us a little bit more cynical on what's going on. Here are the crude oil futures. We saw a new high today, that being retraced. But in terms of whether yesterday's moves hold, of course, we need to see this going through the end of the week. Today we had some fairly strong, what appeared to be fairly strong ADP data, which is the employment, the private sector measured standard for payrolls in the U.S., and it came out what looked like better than expected. However, with the previous month's adjustment, that actually not being that positive. Interesting, though, we see risk coming off just very slightly, actually pretty much unchanged now. But if we look over at bond yields, they're headed higher again, and this is very interesting in terms of what it means for yen crosses. If we look at the bunds over in Europe, they've stretched to new lows. If we look at U.S. 10-year rates, they're heading to the high of this range, which, folks, is very interesting because this has held since the middle of December. Looking at this 3.5% level on the 10 years is being very critical. I think interesting for risk appetite to see if it can continue to rally if interest rates head above that level. And of course, to the downside, something like 3.25. In a very tight range, very long term. This has been in this range, and some questioning whether it even matters anymore because the Fed is pretty much laid a blanket on the U.S. Bond market with its quantitative easing. In terms of Europe, now we have the ECB tomorrow. We also have the U.S. non-manufacturing ISM. Of course, bund yields going higher. If we look at Eurodollar, it did arch to a new high yesterday, even slightly additional high overnight. That's been retraced a bit. Doesn't appear to be in any technical danger, and we could even go through several days and several hundred figures, or several hundred pips anyway, of consolidation, still be keeping a structural view if we're above 134.50. We do see some slightly divergent momentum, but not enough to get us excited. We'd like to see a very strong close back below the old high at 137.60 before we believe that we've seen the top here. Now, as you know from some of what we've been saying recently, we really have a hard time understanding how the market is driving the view that the ECB is really pulling out the interest rate mechanism here soon. They're going to be hiking towards 2% in the coming year, which is increasingly becoming the view. Look at this additional sell-off in the March 2012 Euribor, suggesting another 6-7 bips of interest rate increase in the coming year, getting close to actually a full 100 bips being priced into the ECB expectations. This is very interesting to see this acceleration the day before the ECB is going to come out, and we'd really be surprised to see, of course, that actually happen. But more interesting is understanding what Trichet is going to say tomorrow. And I think, considering the size of the moves recently, there's considerable room for volatility on the rate view, and that could be especially interesting in a pivot sense. And in other words, if we pivot on that view, and Trichet comes out very strongly with very strong language saying, "Look, we're very worried about inflation. However, we don't see any hikes in the near future," though he's always going to say we're never pre-committed to anything. Anyway, if we do see a pivot on the direction of interest rates and the forward expectations, Euro yen, I think, going to be a very interesting one to watch tomorrow if that's the case. We saw a full test of the 618 Fibonacci retracement off this sell-off, and again, Euro yen not coming back as strongly as risk did in general. So this is an interesting resistance area. Of course, if we don't pivot, then the pressure, as we stand now with interest rates going higher, the pressure is very much still to the upside in most yen crosses. And if we look at dollar yen, we saw this test of a massively important trend line, considering that this is close to the all-time lows in dollar yen. We have important resistance not too far away now at 82, and slightly higher at something like 82.30. If we look at the Ichimoku daily cloud, we're looking at this as well. Of course, if U.S. interest rates break higher and the bond market breaking down, the pressure is to the upside. Though technically we have some very sort of pivotal levels here, and it looks like it's going to break significantly whichever way it breaks. So, of course, the downside being more significant because of the longer-term setup here. Whereas if it rallies higher, then we're looking at this ugly range we've been in for seemingly forever. In Aussie dollar, we did break higher, been a bit weaker today. And of course, this can lead to the view that we're headed towards the old highs. But as long as this high is in place, and we even had a 764 Fibo retracement successful, it's all up to risk appetite. What is risk appetite going to do going forward? And your guess is as good as mine on that one. We have plenty of reason to believe it's not going to be as strong as we've seen in the recent future. You could say this last rally again sort of retracing what we had taken out by Egypt, but we haven't really added that much more. And we do see a few signs of divergences in some of our risk measures, but not enough to really build a case here. So it's a question of when does the risk appetite turn for seeing any kind of dollar recovery. Looking at Aussie, we have to see it close back below parity before we can get rid of any sort of technical sign short term that we're going to head lower again. If we head over to the rest of our charts, oh, by the way, on the ECB view, of course, we just showed you that the interest rate forward expectation is very strong. If we look at something like the CDS prices on some of the PIGS countries, here we have the top is Ireland, and then Portugal is in the light blue, yellow being Spain. These have all come off quite a bit from their highs towards the beginning of the year. So the view increasingly that there's less and less risk. The more you sort of analyze the situation quantitatively, the less it's easy to believe that they're ever going to get out of this without some kind of debt restructuring. So again, these will wax and wane. Eventually we think this would turn around, but that is providing the support for the recent euro rally. And we won't see the euro turn back around, one would think, until we saw either CDS prices turn around or the rate view flip-flopping, and for some reason the Fed being expected to hike more than the ECB. Of course, that's not our scenario, just what you would have to see some more fundamental support for that kind of turnaround. Going back to the charts, other interesting developments in Euro Swiss. Look at that, hitting above 130 now since we started this video, and really quite a turnaround here. We did suggest recently the setup here suggested we would test lower. It was a very abbreviated test lower, and we saw actually retracement already on Monday that we didn't point out. But this is looking very bullish for this cross. Again, the blue line here being the old low. So now with this rally here, we've got that as a stronger support, and of course now it's up to the ECB to see whether this continues higher, and we would like that higher in the bigger picture. I would think that the euro, even though we're not particularly bullish on euro dollar going any higher, I think if you look at euro and some of the crosses, or at least broadly versus the G10, seeing signs that it may have bottomed for now. And euro stocky as well. Recently we've seen interest rate spreads beginning to favor the euro over the stocky. We'll see if the ECB is out supporting that notion tomorrow. But really, to get the stocky going lower against the euro, I would suspect that you need to see risk aversion coming into play. Dollar Canada, we did see a tremendous evening star formation. We did see pretty sizable follow through lower, close to testing that old low, not far above 98, but a bit of a bounce today. Let's see if in the bigger picture if this old low holds. And in general, it was a bit not very impulsive the last time it broke to new lows, and we did retrace back above the old lows by these two green lines indicated. So if we do head lower, the momentum may fade out fairly quickly. Also, of course, sensitivity to crude markets. So if we get crude oil heading lower and risk heading lower, that combination, of course, would be very the worst for CAD. If we get crude higher and risk higher, I think CAD will tend to follow, of course, both of those developments higher as well. But what I was going to say is interest rate spread wise, we're actually quite a bit wider in favor of the dollar, but it's obviously dollar Canada heavily affected by crude oil prices. So as long as risk isn't on selling off sharply and crude oil is higher, you're going to have a hard time seeing the CAD any weaker, regardless of interest rates here. One interesting development in terms of CAD crosses, we're not a big fan of the Aussie, as I guess you can imagine, and having read some of our longer-term perspectives on things. An interesting technical turnaround here in the short term in Aussie CAD. We would prefer CAD over Aussie, and in the environment we see going forward, I think some big risks coming out of China, etc. So this is an interesting turnaround today. Sets up this parity plus, 60 pips or so to the recent high here. See if we get some follow through here. There's a bit of a neckline here towards 97, sloping downward, but let's see if we follow through there and get back towards the 200-day moving average in Aussie CAD. So lots to talk about, lots of risks coming up. We have the ECB tomorrow, the U.S. non-manufacturing ISM up tomorrow as well. We'll have a look as well at some of the fundamentals in the coming days. We'll look at that, and we'll look at, of course, some kind of preview of the U.S. employment report on Friday. Until then, we bid you adieu, and be careful out there, and we'll be back tomorrow. All the best. Over and out.